Good morning, good afternoon, and good evening. Welcome to this live CoinDesk webinar, how family offices can enter the digital asset industry. With the rise of digital assets and their role in the global economy, many family offices have started to view them as valid and a promising asset class. And indeed, investing in digital assets can be seen as part of a broader digital transformation of many family offices. It is estimated that 38% of family offices in Asia Pacific have had planned to increase their exposure to cryptocurrencies in 2022. But as a unique asset class, the management of digital assets is not without its challenges. So we are delighted to welcome you today to this webinar, where Hex Trust and Isola Capital will provide insights to help you navigate the digital asset space in a safe, secure, and scalable manner. My name is Nick Lord, and I'm your moderator today. Allow me now to introduce the speakers. Alessio Quaglini is the founder and CEO of Hex Trust, Asia's leading digital asset custodian. Prior to founding Hex Trust, Alessio was the head of strategy in Asia for BBVA. He has also served as director of financial institutions at First Abu Dhabi Bank and at the Italian Financial Services Authority, Consob, in Rome. In 2016, he set up Isola Capital, a cryptocurrency hedge fund. Alessio, welcome. Thank you for joining us today. Also joining us is Anthony Chan, the CEO of Isola Capital Group, the asset management platform backed by multiple family offices dedicated to preserving and generating wealth. Anthony has extensive experience across Asia in corporate finance, private equity, and venture capital. Prior to Isola, Anthony enjoyed a career in investment banking with Credit Suisse, Citigroup, and Lehman Brothers before transitioning to private equity and principal investments. So welcome to you, Anthony. Thank you again for joining us. So our discussion today is going to roughly be broken down into 4 parts. First of all, we're going to look at the driving forces behind family office and ultra high net worth interest in digital assets. Secondly, we will look at the wider issue of the digital transformation of family offices as a whole. Then we're going to sort of boil down into some of the operational aspects of what family offices really need to consider when it comes to digital assets. And then lastly, we will be addressing the questions that come from you, the audience. Now, to submit questions just at any time, if you can write them in the question box on your screen at the bottom there, they will come through to me and we will address them at the end. So that's enough from me. Let's get going. So let's start off by looking at the driving forces behind family offices and ultra high net worth investors' interest in digital assets. What is really sort of driving this? Alessio, perhaps you can start us off.
Sure. Well, let's start from my background, right? So when I started my journey in the blockchain back in 2014, there were actually 2 things that really caught my attention about blockchain and the blockchain assets. So the first one is that the blockchain allows you to create a new asset class. Now, creating a new asset class is not something that happens every day, right? It takes years to create a market after a new asset class is created. So we have FX, we have commodities, we have rates, we have credit, we have equity. And now, thanks to the blockchain, we have a new asset class, which is permissionless blockchain assets. On top of that, the blockchain, with respect to the asset class, allows you to have a certain degree of flexibility in the creation and the design process of the asset. And it doesn't bound per se the asset to a physical limit, like for example, gold, or country borders, like for example, equities or financial markets regulation. So this is the first thing that really caught my attention. The second one that is probably even more interesting is about what the blockchain really represents. And to me, it is a 24/7 global, borderless, programmable, open source, instant settlement layer that allows to store and transmit information in a completely permissionless way. So if you think about even today, after years and years of digitalization, how disconnected and siloed the traditional financial markets are when you want to transfer US dollars from one country to another, or if you want to transfer your fund units from one bank to another. Now imagine a completely new standardized instant 24/7 settlement layer that allows you to do financial transactions, right? And this is really powerful. And if you apply it to the financial markets, it's obviously powerful. But if you apply it to other use cases outside of the financial markets, then it becomes even more intriguing. Now, at the same time, we have basically these assets, we have the blockchain, and we can create this universal settlement layer, we can create new assets, and we can even create a new world where these assets can live, right? And I think these are really the reasons why there's a price behind Bitcoin, behind Ethereum, and other assets. With Bitcoin, we have a new asset class that can represent some kind of a gold standard. With Ethereum, we have a new settlement layer that allows you to settle transactions. With NFTs, we can finally represent real digital ownership in a new world, for example, in the metaverse or in some kind of online blockchain games. Now, the question for family offices or other institutional investors is really, where is this all going, right? So are we at the end of it and we have to just look at the price of Bitcoin, or is this going to evolve into something different? In my personal opinion, we are really scratching the surface, right, of the real potential. Obviously, if we apply this more generally to the financial markets infrastructure, well, I believe that a big chunk of the financial markets infrastructure will be replaced by permissionless blockchain, right? And I think that probably in the future we will have some kind of a Bitcoin standard that will replace some part of the standard on gold that today we have in the financial markets. But I also believe that all the play to earn, walk to earn, work out to earn, learn to earn, etc., and all of these ways of contributing to a decentralized platform to earn valuable rewards will have even a bigger impact on our lives. And this is what blockchain is about, really investing in this development of new ways of doing things, of storing things, of interacting with actually the platform that provides services to you.
Thank you so much. That's a great explanation and a really good insight into how you and your firm sees digital assets. Anthony, what would you say is driving this interest? Is it, as Alessio said, this understanding that each of the different digital assets has some kind of intrinsic value, has some kind of intrinsic use case that derived from which it derives its value, or is it more of a kind of a diversification exercise?
Yeah, I think Alexio encapsulated really well how people might be perceiving, the evolution of digital assets or blockchain in sort of the early stages of its development. And I think family offices and ultra high net worth in general are used to look at things like this. So if you go back 15, 20 years before private equity or venture capital became mainstream, it was really the family offices and ultra high net worth that actually decided to deploy into these strategies. And today we see how sophisticated and how deep and wide each of those categories are, right? Within private equity, within venture capital, and arguably now within private credit. So when you have the resources around you to basically put at risk, let's say, for example, 1 to 5% of your assets, so that you can actually go and learn and understand and educate your team about how to invest in that domain, that's something that a lot of family offices and ultra high net worth are willing to do. With respect specifically to some of the points that you've mentioned and also some of the points that Alessio touched upon, I would bifurcate it just to keep it simple and say that in our experience with the families that we have asset managed for in Europe and in the Asia Pacific, they tend to focus on, at one level, the infrastructure around what we would call blockchain or digital assets. Everything from the custodians to the exchanges to the product providers. And then at the other end of the spectrum, they're looking carefully at what would otherwise be effectively investment strategies, where the underlying would be tokens. And then, of course, at as Alessio alluded to, we're seeing, how things in GameFi and NFTs are also, replicating some of, what in conventional asset classes we're seeing, where people are collecting art or even collectibles. So there is a wide variety of, similar type of approaches, except the difference is the underlying digital assets. But we're trying to find ways for investors to get exposure, from a investment perspective, so it's sustainable and repeatable. So certainly, I think, at least from what we've seen and what we've developed, digital assets is mainstream. And as Alessio said, it's probably at the earliest stage. So there's going to be a lot of development in the future years.
Fantastic. And so do you think that what you're saying about them looking to invest in some of these service providers, that goes back to the old saying that it's always good to be the person who sells picks and shovels in a gold rush. I think a lot of people have been trying that. That's not that investable as a sector, is it? How are you gaining access to that side of things?
No, I think it's actually a great way to learn about the sector. I mean, for full transparency, we've invested in Hex Trust, and we learn a lot, from talking to experts like Alessio and his team. And we truly believe that they are a very critical part of the infrastructure. We talk a lot about DeFi, but realistically, Cefi is where I see a lot of growth, especially in terms of attracting family office and ultra high net worth monies, because for these type of investors, the bulk of their wealth is in traditional finance. And one of the critical components that they look at when they invest is, where are my assets custodied, right? So if you think about it, especially if the product has, a secondary liquid market where you can trade on exchange, right? Or even if it's a private asset class, but it's wrapped with an ISIN code. A lot of these concepts you see now in digital assets, right? Where, you are able to wrap tokens, right? You actually have different exchanges that operate with different levels of efficiency. So as Alessio mentioned, I mean, a lot of the sort of rates, the FX, equities, all of these type of underlying assets that you would trade in TradFi, the same concepts sort of apply in DeFi or CeFi. So I actually think a great way to learn and feel comfortable for families to deploy in this space is to invest in people who are critical components of infrastructure. They see the flows, they see the risk. Obviously we've seen what's happened in the last 4 to 6 weeks, including with some of these situations where it was a governance token, right? That sort of triggered issues. So these are sort of things where once you're invested into the space, not just speculating on movements of specific tokens, you can learn a lot about the risk involved and the players that you can trust in that ecosystem.
Alessio, how do you respond to that?
Well, yes, I mean, from an investing perspective into companies and equity, I think I would agree with your analogy, right? So if we agree on the fact that we will have a permissionless and decentralized economy, if we agree on the fact that the blockchain will replace some kind of financial markets infrastructure, if we agree that GameFi, play to earn, and all NFTs, digital art, images that represent your status on chain will really pick up, and there will be broader adoption across the newer generations and everything, then you will need a number of digital asset players that build the infrastructure. They make it usable, they make it scalable, they make it reliable, they make it transparent. Now, I mean, following what Anthony was saying, probably, I mean, you can invest in players that do this in the CeFi space. So kind of the new banks or the new asset managers, the new exchanges, etc. Or you can pick the DeFi space, right? So for institutional investors, I would say that it's probably more palatable in today's world to try and find the next JP Morgan, right? Rather than find the new blockchain DeFi protocol that will replace JP Morgan. But from a more exotic perspective, I think also the latter investment could be very interesting, and it requires a lot of understanding of how the different dynamics in the blockchain markets actually work.
Okay, and is that a way of hedging against some of the more volatile price movements that we've seen in the underlying coins? And also, has what has been going on in the last 4 to 6 weeks, has that dented family office demand or family office interest in digital assets? Anthony, perhaps you can get that.
Yeah, I'm happy to take that first. Look, I don't think it's dented interest. If anything, I think a shakeout is always good, right? The people that survive this or the players that survive this are most likely the more sustainable ones. And I think through a crisis like this, it will really force people to focus on players who actually have a proper technology or use case that's relevant for the future of digital assets. One other quick point I would make, and sort of partly in response to Alessio, I actually agree with everything he says, but one interesting thing we've noticed, even from a family office perspective, is it is quite stark in terms of contrast when you come across people who are really big believers of the DeFi space, and in fact may have made the bulk of their wealth from DeFi. They are, in fact, as Alessio said, very, very focused in just continue to build assets and grow their assets within the DeFi space. Whereas more traditional wealth that made most of the wealth in the conventional world, for them, it's still, not a place where they would put the bulk of their wealth, maybe not even a quarter of their wealth. So it is going to take a bit of time as the sector evolves before that comfort level, gets to that point where, as I alluded to earlier, if you look at private equity and venture capital today, for a lot of the major endowments or even larger family offices, it could be as large as 40, 50% of their portfolio. So it's quite feasible that digital assets would head in that direction as it evolves over time and as people get more comfort level and get better informed. And I think at the end of the day, it's about knowledge. So those like Alessio who are very, very familiar with DeFi, Cefi, GameFi, TradFi, you obviously have much more benefit from the information asymmetry to invest. And it's going to take time for those with the resources to catch up before they can do the same thing.
Alessio?
Adding on that, I mean, it's what happened in the last few weeks is actually very interesting. So we have the two different sides of financial markets infrastructure in the blockchain. On one side, the Cefi world, right, with all the players. I mean, for example, Hex Trust, that provide more or less different pieces of financial services to institutional investors. And on the other side, you have the DeFi world that is based on smart contracts, is more or less decentralized, permissionless. But what happened in the last few weeks, maybe 8 weeks, since the collapse of the Terra ecosystem, is actually interesting to notice that the DeFi world wasn't really impacted much by the shakeout, and that smart contracts actually worked exactly as they were programmed to work, even the ones that didn't lead to a very good result, right? We're actually following the code and the way it was written. It was just that probably it was not really written for the right purpose in a few cases. But the big problems that we observed were actually in the Cefi infrastructure space, where we've seen a number of the leading players on the investment side and on the lending and yield generation side, they actually went belly up. In the typical normal credit crisis that we've due to leverage and taking too much risk that we've seen in the traditional financial market several times. Now, the interesting part here is why it happened in the Cefi space first and not in the DeFi space. And I think it's a question of transparency. In the DeFi space, the code is transparent, it's open source. So when you put your assets in a platform, you know exactly what the code will execute and do with those assets. When they are lent out to generate a yield, you know exactly what is the collateralization level that your assets will be lent at, and what is the risk that you're taking on the platform. Right? In the Cefi space, we really found out there was no transparency at all. Right? Most of the companies were saying that they had all of their risk mitigation processes, all of their real-time monitoring of markets movements enabled. Actually, they didn't. Actually, your assets were taken. They were not in safe custody, and they were lent out either unsecured, so without collateral, or with very low collateralization levels. And this lack of transparency is, I think, it's probably quite normal in the financial markets history. But at the same time, it's a little bit exacerbated by the fact that there is really little regulation, and there is really little level of control on what these financial institutions with billions and billions of dollars of balance sheet can do. Right. So it happened also in the traditional financial space, but in a new space where nobody checks what you're doing, there is really too much incentive when you are sitting on billions of dollars to not do things in the right way. And I would say that most of the companies that went belly up were basically made or created by very experienced financial markets professionals. So it's really the lack of control, of monitoring, that gives you the wrong incentive for non-transparent centralized platforms to try to extract too much margin from your operating activities.
That's a great insight. Thank you so much for sharing that with us. Let's move on to the second part of the conversation now, about family office digital transformation. Anthony, perhaps we can start with you. How do you see, how does digital assets actually fit in with the wider agenda of the digitalization of family offices?
Yeah, well, the digitalization of family offices broadly, if I interpret the way you're presenting it, is actually to do with just application of technology in terms of reporting. Very often, one of the hardest things for family offices is to report across asset classes, across jurisdictions, and to get live information about, all their positions, right? Because you're investing across a range of liquid secondary assets that trade in different time zones, and then different currencies, and then you have different private asset classes that are held in different vehicles that don't report on a daily basis. And then finally now, as exposure is put on for digital assets, even though the technology exists to get pricing and information, there is no system that can integrate all this data together. So we've seen people try to create interfaces to help on that reporting front, and that's something I think intrigues a lot of family office setups or ultra net worths who are managing a lot of their own assets. The other aspect to it in the future is, as Alessio sort of alluded to, is who will be disintermediated once the blockchain technology is put in place to report on the various asset classes, right? So everyone from fund administrators to real world custodians to even some service providers that are wrapping assets. So there is some risk there. So I think all of those sort of service providers are looking at ways to add on that technology to make themselves more relevant. But then in terms of how this translates to investing more from family offices into the digital asset space, as I mentioned earlier, I think it's about learning. It's about getting more informed. It's about basically paying tuition by dabbling in different types of, digital asset classes. And sometimes you will get burned. So it's important to work with experts and work with people who have infrastructure that's credible. And this is, one of the biggest learnings from, I guess, what's happened in the recent, 4 to 6 weeks. One other point I'll just make in terms of what Alessio was saying earlier, I also wonder if it's simply just the Cefi infrastructure failing, or if it's because, it was so lucrative in terms of what was being on offer from a staking, a very simple staking protocol. And I guess people get carried away. And as Alessio said, when the money comes in, I guess risk management, is sidelined and diversification isn't top of mind. So these are things where I think when something like this happens, it's great information, right? It's a great way for families and ultra net worth who want to continue to invest in this space. You see what happens if an incident like this occurs, and you see where the pain points are, and allows you to be smarter in terms of how you deploy in the future into the various types of investment strategies in the digital asset space.
That's great. I just want to remind the audience that the question function, the Q&A function, is available. We have two absolute experts in this field, and you can answer questions on anything you like, really. But if we could keep it specifically to the issues pertaining to today's discussion, that would be great as well. Alessio, Anthony just came on to, it was a very good way to bridge into the third part of our discussion, which is really about the top considerations that family offices need to have when it comes to digital assets, especially on the operational side. And by that, I mean their custody, any kind of ownership obligations that come with them. Perhaps, are you able to outline some of the things that they really should be taking into account when they're considering getting into digital assets?
All right. Okay, so when we look at the digital asset class, actually, we're not looking at one asset class, but we're looking at a number of asset classes. But first, let me make some kind of comment on what actually digital assets are. I think there's a lot of confusion still today on what it actually means to invest or hold a digital asset. So most of the financial assets that we actually invest in today in the traditional financial world are actually digital already, right? So your US dollars in your bank account are most of the time, unless you withdraw them from the ATM machine, but most of the time they're just digital entries in some bank's ledger. Your equity, your HSBC shares are basically another digital entry in somebody's ledger. Even your health insurance, right, is probably the rights attached to it are probably stored in somebody's server, right? So when we invest in digital assets, and with specific reference to blockchain, what are we really investing in? We're investing in an asset that is digital by nature, but at the same time, it is a decentralized and permissionless asset. This means that it is not controlled, usually, at least it shouldn't be controlled by anybody, but the control of it is decentralized, and nobody should be able to print more Bitcoins, for example, change the order of transactions, or provide a service without having the right ownership rights to do that. Right, so the assets in the traditional markets, the digital assets in the traditional market are still digital, but are fully issued, controlled, and or stored by a centralized institution. So I think this is something that really is a big difference when we look at digital assets issued on blockchain, and it has a lot of implications on kind of the considerations that investors have to do before investing into this digital asset class. Now, secondly, within digital assets, we're talking about lots of different assets that investors can buy into. So we can have a new digital asset class that is similar to gold in a digital way, as I think is today's everybody understanding for Bitcoin. But another digital asset could represent the fees that are paid to access a service or access a settlement network such as Ethereum, right? So you buy ETH because you believe that there will be more transactions eventually on the Ethereum network, and by holding the token that has to be purchased to pay for the fees on this network, you think you'll be doing a good investment. It could represent a fiat currency representation, for example, a representation of US dollars in some shape and form on the blockchain financial markets infrastructure, or it could also represent any other type of identity or right in this world, or even in a digital world that everybody is talking about today, that is the metaverse. Right? So it could be your identity in the metaverse, which includes information on how many characters you own in a specific game, or how you rank in terms of your quality of playing in a specific number of games that are written on blockchain. Or it could also represent your status if you buy a specific ape in a similar way that Rolex or a Hermes bag represents for you in the real world. So these are all complete different assets, but they're all under the same kind of umbrella of blockchain digital assets. And why are they under the same umbrella? It's just because of a technological reason. They all use the same technology, they all use blockchain, hence they all have some common traits, but the asset is different. Lastly, these assets, when we move to the kind of digital asset universe and we move to this kind of global, programmable, open source world, the assets are not purely ledger entries anymore, but the asset itself is a piece of code. It's usually a smart contract, and it embeds within the asset some features and characteristics. So when we buy that asset, it is important that we understand what that asset can actually do. Most of the assets that are issued today, they have functionalities that are written in the code of the asset itself.
Yeah.
So some assets, they offer governance rights. It means that the governance token of a DeFi platform, by holding it, you have some governance rights to change some parameters in that specific lending platform. For example, you can vote on the collateralization level of the lending positions that the DeFi platform will take, right? Some others, they give you a right to earn or to receive an airdrop. So if there is kind of I don't know, in the traditional world, maybe a stock split or a dividend, right? Some other assets, they give you the right to participate to the integrity of the network itself. So if you hold the asset, you can stake the asset to some validator nodes, and you participate to the integrity of the network, and you are rewarded with a certain staking yield for doing that. Or some other assets can be used to generate new assets. So for example, if you imagine that if you have two apes, right? These two apes could together generate a new ape that is a new NFT and has different traits from the two original apes that have generated the new ape. So when we really enter this digital assets world, we need to really think about what it is, the permissionless level. We need to think about the different asset classes, and we need to think about the functionalities of these assets that in turn have an impact on how we monetize and we generate return from these assets.
So that's a much more active kind of management process that's involved in it than maybe in the traditional markets where family offices would just have a block of shares, have some cash, park them away, and just wait for the dividends to roll in or the interest payments to roll in. It sounds as if it's much more involved. Anthony, how could you give us your experience of how you actually manage the process of managing digital assets on your behalf and for your clients?
Yeah, I think what Alessio said is very true, but I also think at a basic level, they're so analogous to a lot of the TradFi products. So, when you have a governance token, it could be the same as if you had preferred shares, or if you were the largest creditor for, a particular bond issuance, you'd have, certain rights, right? And if you look at, how some of these digital assets utilized right now, because the use case is so different, right? There are analogies or similarities with conventional assets. So I don't think the gap is massive, and that's why it's easier for people to grasp what it is that they're investing into. But as Alessio said, when you get further in the evolution of digital assets, and I like the fact that we're focusing on calling everything digital assets, because I think the vernacular, when you say cryptocurrency, confuses people, right? I mean, cryptocurrency is not really currency. Some of them may function or have certain functionality like a currency, but that's a massive debate in itself. So I think when you think about digital assets, that's exactly how we look at it, right? We're investing in an asset class, and within that asset class, there are many different types of digital assets. And in some of these digital asset classes or subclasses, there are strategies that you can build around to create value, because the essence of investing is hopefully to create value, right? Not to destroy value. But I think there's also, like what Alessio mentioned, if you like collecting luxury watches or handbags. So there are also investors in conventional markets who collect real watches, real bags. So in the digital asset space, it's because they have a perspective or a view in terms of whether those particular NFTs, are valuable in the future in a particular, metaverse context. So I think there's a lot of similarities, but what is really clear, even just listening to what Alessio is saying, is there is a massive information gap between, I think, people who are generally investing in traditional finance, and I think even very sophisticated families are still learning, right? So I think that information asymmetry is what's helping certain players who may themselves not have much background in traditional finance or learning how to invest to make money, because once you have information asymmetry, right, in digital assets, you know where to arbitrage, you know where to make that gain. So I think that's something very interesting to observe, and I think that's something that we'll continue to monitor going forward.
Fantastic. Well, we're getting questions in thick and fast now from the audience. So I think we will dive into these questions for the last 10, 15 minutes. How will the use of digital assets impact operating businesses and direct investments? So I suppose this question is talking about the crossover between digital assets and then, as you say, the actual operating businesses themselves, both in crypto and in traditional businesses.
Maybe I can take this one from
yeah.
Maybe I can take this one from a markets infrastructure perspective, right? So I think basically looping back on what I was mentioning before, that the lack of regulation actually made it more complex for the Cefi players to operate in this high volatile market. I think the lack of regulation also puts an additional burden to the investors, right? So there are a number of different perspectives to look at it. So firstly, as we mentioned, what the players do with your assets is not specifically defined in any kind of regulatory handbook, right? So you have to have a little bit of understanding of who you're interacting with in the market. And most of the time you would be interacting with newish players that have not been around for, there are very few companies that have been around for more than 5 years, right? So you'll be dealing with companies that have amazing marketing campaigns, amazing websites that have been around for 2 years, that are not subject to any regulatory framework, right? So you need to really spend time to do some due diligence on the counterparties that you're interacting with in the market. But secondly, and more importantly, in the traditional financial markets, banks can fail, right? So you still need to do your own due diligence when you deposit your US dollars in a bank. But there are certain things that are more or less taken for granted, and they usually actually happen because there is no way of kind of living in the traditional financial markets if you don't follow those kind of best practices. So asset managers, they need to segregate the assets that they manage from the assets from the asset manager, right? So they need to a custodian, right? The assets that are held in custody, they're not part of the custodian balance sheet, right? But they are held in a segregated account or in a kind of bankruptcy remote vehicle that protect the assets from any claims from creditors of the company. Now, these are just two examples, right? So all these things, I think, basically happen in most cases in the traditional financial markets when you deal with developed markets. In the blockchain space, you have to do your homework yourself. When every time you interact with the Cefi markets infrastructure, you need to make sure that you're really interacting with a custodian. And when you're interacting with a custodian, you really need to make sure that your assets are legally segregated from the custodian's assets, and that there is a kind of bankruptcy remote kind of framework that has been that works in that specific jurisdiction for your assets in case something happens. And we will see a lot of this in the next few months, since several companies already filed for bankruptcy. So we will see how the lender, so the retail clients that have deposited assets in custody with these platforms, actually rank, right, during a bankruptcy process. So I think, for going back to your question, in the process of investing, there's a lot more to do on the investor side, or probably the investor really has to get the help from somebody that professionally can do this and is able to actually understand the different pieces they have to work to protect their investments.
Are there any particular trust structures, corporate vehicles, jurisdictions that you think are particularly well suited for managing digital assets?
Well, I would say that all the top tier jurisdictions that are leading in the traditional financial markets, they allow you to do things in a proper way also in the digital asset space, at least at the custody level.
Yeah.
Now then, you go up the ladder of financial markets services. So if you go to the secondary market or the primary markets, there might not be regulations in place for exchanges or for brokers or for prime brokers or for asset managers, for advisory companies in all of the jurisdictions, right? But there are jurisdictions that are quite advanced, right? And we've heard a lot about Singapore, we've heard a lot about Dubai, we heard a lot about Europe, that in the last few weeks came up with a new new framework. So you can choose players. Obviously, the US they have they're leading the way, right, in this market as well. So you can choose actually players that are not registered in fourth tier jurisdictions, because they want to run their business without any control or monitoring by any authority. You can choose first tier jurisdictions, and a few players that actually registered there, they have spent the time, effort, and money to obtain a license, which means they have all procedures in place, different maker checker segregations, etc., that we're used to in the traditional financial markets.
Fantastic. Anthony, we've got two questions for you that have come in, and I'm going to ask them both at the same time, if that's okay. So firstly, other than custody of digital assets and being more informed, what are the other common hurdles that family offices face? And the second question, which is on a similar kind of point, it says, Anthony, could you elaborate on your point regarding digital transformation of family offices? It requires training and education, system integration, and one other. What was that one other? So what we're really asking is, what can you go over what you said again about the digital transformation? And secondly, what are the other common hurdles that family offices face?
Yeah, I think maybe the second point first, right? I think it's really about also having the right resources internally. So it's similar to my point on knowledge and information, but you also need somebody within the team who actually understands the technology. If you don't have that, then you have to work with partners. And that's what I said. So you work with either qualified people, or you bring in-house maybe at least one individual that really has deep knowledge in terms of what's evolving in the digital asset space. Because it's not as simple as learning coding yourself. You need people who are effectively very knowledgeable, maybe almost digital natives. So that's something I would suggest. With respect to the first question, I think maybe another way to think through this, at least from our experience right now, if you consider let's say a meaningful size family office or ultra net worth, generally they're still making decent returns, right, over a period of time. So when we talk about being able to put 1 to 5% or even 10% at risk, it doesn't have to be just digital assets. But if it were digital assets, it's like what I alluded to earlier. It's almost like paying a tutoring fee to have the opportunity to invest into whether it's digital asset infrastructure, different types of digital asset investment strategies within different jurisdictions, since we were talking about that earlier, to learn about it and to gain from that learning to figure out where you really want to be putting more of that asset, those assets in the future. So it is a learning process, not just by watching and reading, but also by actually deploying. And that will allow your team to figure out internally what type of resources you need to put around reporting. But I would imagine that a lot of the external fund administrators and in fact some of the custodians either are investing in digital asset technology businesses or businesses that have a lot of blockchain capability, so that they can enhance the reporting requirement, which I think the families will be looking for, right, as they gain more exposure.
Fantastic. We've had 2 questions on the subject of US banks, and when do you think they'll become comfortable offering digital wallets for US stable coins? When will they start offering more widespread digital asset services? Alessio, presumably you don't want that to happen.
Sorry, Nick, you need to repeat your question.
Sorry, I was going to say, do you think, are there any signs that the US banks, the big global US banks, are entering into the digital asset space at the moment?
Yeah. So there are, lots of, several US banks have invested actually in different pieces of the infrastructure, right? So
right.
Goldman has made a number of investments already. Actually, 3 years ago, they invested in BitGo, that back then was the largest custodian before it was acquired by Galaxy. They recently have announced, probably 6 months ago, their investments into Anchorage, which is kind of the new upcoming custodian in the US. And they've made an investment in Certic, which is a company that does audit of smart contracts. But Goldman is not the only bank. Several banks have invested in the latest, some of the latest rounds. BNY Mellon has invested in the Fireblocks round. So I would say all of the major banks, they already have their kind of they've taken the first step to enter the space directly by doing equity investments. Now, from making an equity investment to become a competitive player in the space, I think it will take a number of years, right? But it will happen. It will happen, but there's a lot of kind of the learning curve is quite steep, and banks are usually very careful not to put a stake there. Current business and operational model for a new asset class.
Okay, that's great. In your opinion, how, in your opinion, should family offices treat tokenized securities? For example, would investing in tokenized shares of public or private companies require the same sort of digital assets infrastructure players that Alessio mentioned are needed for investing in digital assets? Where do you see that? Anthony, perhaps you can talk about your views on tokenized securities.
Look, we're stepping into a regulatory, sort of discussion, but you can imagine anything defined broadly as a security in most jurisdictions would be regulated, right, by a local regulator. So by tokenizing, securities, you're basically going to have to bring in the regulator. And I think regulators have been either reluctant or not ready to step into that space. So I'm not sure that we're going to be quite there. And if you look at what happened with stablecoins, a very simple example of trying to tokenize something that's effectively underlined by supposedly the US dollar, or I guess Tether has other sort of liquid assets that are supposed to back it. But is that successfully translating to something that could potentially generate targeted returns with a certain level of risk return profile that you'd see for the actual underlying security? Probably not. So it really depends on what your objectives are, right? Normally, I think if you're a family office or ultra high net worth, you're too sophisticated to be investing on a speculative basis. You're not trying to buy low, sell high, or flip on a regular basis. What you're trying to do is to say, I have a pool of assets or a certain amount of capital that I want to deploy. How do I, first of all, allocate it so that it generates a targeted type of return that fits my risk return profile? What portion of that would distribute annually? What portion of that would stay and snowball? And what portion can I take serious risk on so that in case I get wiped out on that exposure, I'm okay because I'm making enough returns with the rest of the portfolio every year. So these are probably sort of the considerations that should be, top of mind. And then when it comes to, when the technology gets there, I don't think it'll be the simple tokenization. It will be, what is the regulatory framework that allows you to tokenize securities, and who are the intermediaries that are allowed to distribute them, even if the custodians are already there.
Fantastic. One last question, maybe, actually one from me. Inheritance. Obviously, inheritance plays a large role in family offices, certainly in considerations and things like this. Have we actually come to a full understanding of how digital assets can be inherited, for a start? And secondly, because certainly, essentially, they're securities in bearer form, are they really just an incredibly efficient way of inheriting?
I can take a crack at this. So first of all, I wouldn't call them a security in the first place. Let's call them an asset class.
Okay.
There are different types of structures you can put your assets into, which, depending on where you're domiciled and where your beneficiaries are domiciled, would allow you to transition those assets to them, in a tax optimized version, if I can put it that way. So it could be something like a private placement life insurance policy. It could be a trust structure, could be a combination of those. In some jurisdictions, it could be just a simple corporate structure because there may be no inheritance tax, and you can transition those. So it's very much, bespoke to the particular circumstance of that individual, that family. But I would imagine that in most jurisdictions, it will be treated as simply an asset in that structure. I'm not aware of any major jurisdiction where digital assets are treated specifically differently, so that if you put it into the right structure, you wouldn't have the benefit of that structure from a tax perspective. I think in the key jurisdictions, if you put in the right structure, you will get the same benefit as the other asset classes.
But I would say you better choose the right custodian to do that.
Yeah.
Of course, yes.
Exactly. Well, on which note, I think we will pull proceedings to an end. I want to thank you both very much for an absolutely fascinating discussion we've had over the last 55 minutes. We've covered a lot of ground. I think we've really got some insights into how family offices view digital assets. I found it particularly illuminating that they're as much interested in the companies that are running the infrastructure, that are selling the picks and shovels, as they are in the actual underlying gold. I think that's a really interesting insight. And also about the considerations that they do need to take into account with active ownership and management of those digital assets once they've got them. So both of you, thank you very much indeed. It's been an absolute pleasure to interact with you this afternoon. Thank you all to the audience for all your questions. They've been great. I'm pretty sure we've answered all of them, if not specifically then earlier on in the discussion. There are some other specific ones that we might send directly to the panelists themselves, just so that they can reply personally. So that's it from me. Thank you both very much indeed. It's been great. Goodbye.
Thanks.
Thank you.